Hello and welcome everyone to this week's weekly market recap for the week ending Friday, February 21st, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with you all again this weekend. Not so much pleasure to watch the stock market last week, though, as we had a pretty good meltdown toward the end of the week. Going to talk about that quite a bit. We did have some housing reports out last week that weren't good. I know that the Dow Jones Home Construction Index did finish on Friday at a 52-week low. So that certainly put some pressure on the discretionary group, discretionary and staples. That relative performance there is a really big topic for last week, something I wrote about just a little bit ago over at stockcharts.com. So make sure you check out my Trading Places blog over at stockcharts.com and check out the article. Just going to go ahead and jump into some of the action. I can tell you that the price action that we saw last week, I think, confirms that we have a top in place. In order to be proven wrong, we're going to have to see another new high come in. Otherwise, I think we've probably topped and could see some weakness. And this is what I pointed to back at Market Vision 2025 back in early January, when I said I thought we would have a pretty choppy first quarter and that potentially we could see a correction develop, maybe more, but or at least some weakness in the first quarter. And I think that the Friday action pretty much, put a hammer in the coffin for the bulls, at least for a short period of time, or maybe a nail in the coffin rather. But anyhow, let's take a look at the action from last week. So we had the S&P 500 for the week dropping 1.66%, 1 2/3%. So you're probably like, hey, what's the big deal? 1 2/3%. But it's on top of all the other warning signs. If you've been listening to what I've been saying over the past 3 to 4 weeks, I've been just beating that drum that, hey, things are changing. We're seeing a lot of rotation in the market. We got negative divergences. Things just haven't looked, to me, very good. I mean, we've had a tremendous amount of bullish sentiment. The VIX, though, has remained elevated. Even though price action went to an all-time high, we haven't seen the VIX really drop much below like 15. And it shot up on Friday with the selling. So that's, part of what the problem is going forward. So it was some of the setup going into this week's selling, and especially the selling we saw at the end of the week and the nature of that selling, which I'll talk about a little bit more. NASDAQ 100 down 2.25%, Dow Jones down 2.5%, mid-cap 400 down 3%. Then we had transportation down almost 3.5%, and the Russell a little bit more than 3.5%. So that relative weakness in small and mid-cap stocks continues as well. And I really don't see a way out of that until the Fed, or until at least the stock market believes that we're going to get rate cuts later this year. I think that's where the outperformance in small caps the second half of 2024 was coming from. And once the Fed kind of changed the way they were looking at inflation and, their approach to interest rates in 2025, once they started adjusting that, we've seen underperformance by small caps. So until we get back onto that train where we can expect some rate cuts down the road, I think that we'll continue to see small caps struggle. Looking at the sectors, this is where, just take a look at this leaderboard. This is in a nutshell where we get all of our problems from, or why I'm so cautious heading into the next several weeks. Consumer staples last week did really well, gaining almost 2%. Utilities up 1.5%. Healthcare up 1.1%. Energy, which I consider more to be a neutral sector, that was up about 1%. Real estate, 0.5%. Those are all either neutral or defensive groups. If you're looking for the aggressive groups, they started at minus 1.97% last week. That was the industrials. Materials, another neutral, what I consider neutral group, down just under 2%. Then we had financials down 2%. Technology, 2.1%. Communication services, 2.2%. And the biggie, and this is what I was talking about with home construction and some of the other areas within consumer discretionary, down almost 4%. Look at the difference between consumer discretionary and consumer staples last week. You say, okay, the S&P only went down 1.6%. Well, it's not just that. It's the the way the money rotates, consumer staples last week outperformed consumer discretionary by close to 6 percentage points. That is one of the widest margins I've seen. I mean, it's been a long time since I've seen anything quite that bad. So it's just that the market is not setting up well going into this past week. And then with the action we saw last week and the pretty bearish action Thursday and Friday on our major indices, I think that's confirmed that we have seen the top, at least for a while. I don't think for 2025, but I think at least for a while. 10-year Treasury yield, you see that coming back down. So I guess, bond market saying what inflation, but it might be sending us a different signal. It might be saying it's the economy, and you see these reports coming out on housing. Initial jobless claims last week rose a little bit. I feel like we have economic issues brewing under the surface of the market, and the Fed, if they continue this mantra that we've got inflation problems and that they're going to be rekindled and we're going to see a surge back higher in inflation, and it doesn't happen, then they've left rates too high for too long, and that could eventually lead to more economic damage down the road. And so that's some of the signs I'm seeing, and we're going to have to pay close attention to that because we don't get another Fed announcement and a Fed decision policy statement until sometime later into March. So we still got a few weeks where we got to deal with, for me, it's like, what's the catalyst? What's the bullish catalyst right now? I mean, not only are we seeing rotation out of bullish areas, which right there tells me to be cautious, but I just don't know what what in the next couple of weeks, few weeks, is really going to drive the market. I think, when we get the inflation reports out again, middle part of March, that's something that could help if that comes in lower than expected. But outside of that, most of the earnings reports are in. So the buy on the rumor, for the most part, is over. And now it's just simply a matter of sell on the news, along with a lot of other issues that we have out there. So anyhow, normally I would be in favor. I'd be liking this 10-year Treasury yield coming down a little bit. But given what's going on in other areas of the market, to me, it's just telling us that maybe we have an issue with the economy. S&P 500, you can see that big turn down. So if you go back since we set this new high, since we went back up above the December high, we really hadn't seen a big sell-off like we saw on Friday. Now, it was options expiration. So, monthly options expired on Friday, and that can have a big impact in the market sometimes. Volume picked up, but that's normal when you get options expiring. So, I look at this and I say, well, it was a horrible day for sure. But it was really more the rotation that occurred during the day than it was the actual sell-off itself. The sell-off was bad, but I'll give you a look at a chart in a minute that'll show you what I'm talking about here with the rotation. NASDAQ 100, also a big drop. Look at the break below the 20-day moving average. Now, I would argue we're in sideways consolidation mode and that the moving averages really don't matter. It's really the price support. So we could go back on the NASDAQ, for instance, and look back to about 20,700. 20,600, something like that. I think, and that's another 5% below where we are right now. So, that would be more of a key support level. And you could go all the way back to the gap support that has not been tested since the election. And that would take the NASDAQ 100 down to probably about the 20,200 level, 20,200, 20,250, something like that. And so that would be another maybe 7% from where we are right now, 6-7%. And that would be getting us pretty close to the correction zone, 10% widely considered a correction. Small caps, could not break above, already underperforming. We saw the NASDAQ and the S&P both going up and setting new all-time highs recently. IWM never even got close to that. Same with the mid caps. So I just see this rolling back over. I really want to watch this support area down around 214. If that doesn't hold, I mean, small caps potentially could go back to a 52-week low. We got a couple of other support areas. You got one here around 205. You got this one down around 197, and then this one at 190. But if the market is really weak over the next, month to a couple months, it's possible that this goes all the way back down to that 190, 89, 190 level. Not calling for that at this point, but I think the odds are growing that is a real possibility. Transports, what was it last week? We were talking about how good the transports were doing, trying to make a breakout. Yeah, that's over. Now we're down hoping that support holds, and that support for multiple months now has been around 15.7 to 15.750. Closed below that, and I think just like the IWM, we're talking about maybe 14.750, another 1,000 points, which would be another, 6-7% from where we are right now. XLY, this is what I wanted to show you. This is an intraday 5-day chart. Now, I want you to look at the XLY, the selling Thursday morning, little bit of a rally, and then pretty much selling all day long on Friday. But if we look at consumer staples, what's going on here? Gap down on Thursday, where we finished up near the high of the day on Thursday. And then look at all the buying all day long on Friday. Discretionary stocks all day long going down. Staple stocks all day long going up. Why is money rotating so heavily away from discretionary and into staples? Why is there such an interest in defensive stocks all of a sudden? Well, that's what you typically want to be in when the market's going to go lower. So I can tell you that the ratio of the XLY open on Friday versus its close, it went down, I don't know, well, we could probably take a quick look at it, from 224.80 down to 218 and change. So that's, more than $6. So that's over maybe 2.5% in discretionary stocks moving down during the day from opening bell to close. And then on this side, you've got 81.20 to 82.20, which is $1. That's another $1.25. Anyway, if you take the difference, or I guess take the minus 2.5, 275, whatever it is, and add it to plus 1.25, or actually subtract 1.25, you come up with a net difference between the two of about 4%. Now, I went back in history, and this has happened only 10 times since the bottom of the financial crisis in March of 2009. It had only happened 9 times before Friday, over 15, almost 16 years. Actually, it had been 16 years. And it had only happened 9 times. This was the 10th. The key is that the last 9 times it's happened, 8 times have been during bear markets. 1 time was during a correction. This is the 10th time. So is this going to be the one where we just ignore it and go higher? I don't think so. I think this is adding on to the bearishness that we've talked about and the cautiousness, talking about being in cash for, last month or so. This is what the signals over the past month or two have been leading me to. And we finally saw it. We've seen a little bit of, we saw some gap downs. We saw it with the DeepSeek news a few weeks ago, 3-4 weeks ago. We saw it with the trade war news over the weekend, but both of those were gap downs. They weren't distribution. They weren't selling all day long. They were gap downs, and then we recovered. Both of them. This was different because, again, if you look at the XLY, this was a gap up, and all-day distribution. Not good, especially when that money is rotating out of that group and going right into staples. It's pretty clear. Anyhow, I'm going to talk a little bit in my EB Digest article tomorrow morning, Sunday or Monday morning, about where I think we could go. I'm just going to give a couple targets to the downside. So if you want to, check that out, and you're not already a Earnings Beats Digest subscriber at Earnings Beats, go to our website, earningsbeats.com. bearish.com, both plural, earnings beats, and then just scroll down right here and subscribe to our free Earnings Beats Digest newsletter. Name, email address, that's all it takes. And you can sign up. There's no credit card required. We have articles that come out Monday and Wednesday of every week. And there are literally tens of thousands of folks that have subscribed because we don't put any pressure. If you don't want to subscribe any longer, you can cancel at any time. And like I said, there's no credit card required. Just come in and just get two articles a week. Usually it's educational. Sometimes it's a trading candidate that if you want to trade it, that's fine. We are not registered investment advisors. So they are not recommendations. That's not advice. Shouldn't be looking at it that way. You should be looking at it as education. And if you decide to pull the trigger, you might want to consult with your own financial advisor first. But obviously that risk is on everyone who reads the articles. But we just try to teach our methodology and the way we approach the market. I don't think anyone out there has covered the market and called the market better than we have over the past several years, all the way before the pandemic, all the way back into 2018 with the trade war. We've got a history of making some pretty good market calls. And I'm proud of that fact. But anyway, I want to talk a little bit about the seriousness of this episode, this selling episode on Friday. So if you're not already registered as a free subscriber, simply name, email address. That's all it takes. Make sure you check that out. Also, if you're on your mobile device, we have a QR code that's on your screen. You can scan that. That'll take you right to the landing page where you can just sign up again. It's free. No credit card required, name and email address. So last Tuesday, we had our Max Pain event. We do this for our members. We do it every single month. It's the Tuesday before the third Friday. Why the third Friday? Third Friday is when monthly options expire. And so a lot of times what happens is the market has a history of going higher in the middle of the month, leading right up into options expiration week. And so on Tuesday of options expiration week, we will have a Max Pain event webinar where our members can join us and we just talk about the risks leading into options expiration Friday and into the week following that, because many options don't just get closed out, they can be exercised. So if you've got a call on a stock, you can then exercise that into 100 shares of that stock. You can buy it at the strike price of the option you trade. So this market maker impact, bringing stocks back down, can actually last into the following week. And usually it does. But anyway, just take a look at Palantir here on this chart. This was a chart. This was a stock we featured on Tuesday. It was trading at 124. And what we calculated was Max Pain coming in at $83. Now, I said at the time, I don't use Max Pain. And by the way, Max Pain is the point at which market makers would pay the least amount of call and put premium combined. That number, I think, was like 1.3 billion that they would have owed based on where Palantir closed on Tuesday. And by the time we got down to Friday, we had wiped out more than, well, if it had gone all the way down to 83, that 1.3 billion would have dropped, I think, to around 700 million, 1.3 billion. So it would have saved market makers roughly $600 million if it had gone all the way down to 83. Now, again, is a stock from 124 going to drop $41 in 3 days? Well, what we said is no, probably not. But we've seen some strange things happen in the market during option expiration week. And all I said was I wouldn't be buying Palantir at 124. Wait until this risk passes. And I don't think the risk is over just yet. But look at Palantir. Closed at 101 last week. It was down $23, which was more than half of that $600 million that market makers could have saved. So probably they saved somewhere $350 to $400 million by this stock coming down over those last 3 days, Wednesday, Thursday, Friday of last week. That's why you don't buy Palantir when it has all of these in the money call premium, all this in the money call premium, net call premium, and still 3 days to go to option expiration, because market makers can pull the carpet out. They don't always do it, but they can. And that risk to me is very significant. So what I want to do is just go through some of the stocks that look a little bit like Palantir, or looked a lot like Palantir going into option expiration week, or maybe even a little bit before that. Here was Reddit. Here was Reddit back earlier in February. Look where it is now. It dropped from 230 to 160s. How about APP? Remember AppLovin? Big gap up, got to $520. On Tuesday, it closed around $500. You know where it was on Friday? $415. $85 drop over 3 days. Market makers are crooks, but it's legal. Spotify. Look at Spotify. Hot as can be. All of a sudden on Friday, dropped 4.6%. Dropped $29. Sure, that saved them some money. Meta. Meta was up over 700, got about 730, 735. Where did it finish? 683. Carpet out from under the feet. If you had options in any of these stocks, call options, and you lost a bunch of money Thursday and Friday, call up your local market maker. Congratulate them. Here's Netflix. Look at Netflix. Last Friday was at 1,060. We finished 1,003 this week. CrowdStrike. So CrowdStrike up near 460, finished at 406. Telling you, thieves. Airbnb, after earnings came out, got up to about 164, finished 146. And this was crazy. Digital Turbine, APPS. Last Thursday had closed at 650, got as high as about 680, maybe 690. In 5 trading days, went from 690 to 423. If you think market makers may have, stolen from a lot of unsuspecting options traders, you would be correct. That was a massive drop. And look, I mean, when you're thinking of it, the whole scheme of things, when you have a stock that's gone up so much and it's been, big volume, the problem is you have a lot of room down to the 20-day moving average. All we did last week was come down and test the 20-day moving average, went slightly below it, 423 versus 427. But what it did to the options, the value of the options, was criminal. But that's the market we have. And unfortunately, we're going to have it for the next month, or every month, I should say. And we'll see what happens with the overall market. But I think options expiration is what got the ball rolling. And now that we've gotten the ball rolling and we're seeing that big rotation, I think the ball, it's not to say we're not going to have a bounce next week at some point. I just don't think we're going back to new highs. And I think after that bounce, if we get one, you will see more selling coming down the road. Anyhow, stay tuned to earnings beats, to our weekly market recap. We guide our members at earnings beats every single day. You can go over to our website at earningsbeats.com. We're right here. We have a 30-day no-cost trial. You can set that up if you'd like. Come to all of our events that we do. We're going to have some educational events coming up in the next couple of weeks that this free trial will cover. We'll be talking about those educational events coming up. But now's the time. If you haven't joined us and you want to try our service, check us out now. We're going to help you get through this turbulent market period. And then later in the year, I think we'll actually have a pretty nice rally. But it's going to be tough getting there. We're going to need a bridge here to climb into that more bullish time period later this year. Anyway, have a great rest of your weekend, everybody, and I'll see you next week. Happy trading.